Every fair value gap has two readings, the one that fills your order and the one that fills someone else's. Most traders never learn to tell them apart. Some chase price after the move already started. Others get trapped by inducement before the real movement even begins. In today's video, we're going to break down a complete smart money fair value gap strategy step by step, using real chart execution, multi-time frame analysis, market structure, Fibonacci premium and discount zones, liquidity concepts, and precise risk management. You will see how professional traders identify high probability fair value gaps, confirm change of character, position entries around the 0.382 retracement zone, manage partial profits correctly, and how they recognize the gap that exists only to trap them. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before we begin, one important detail is why I use the letter P in some market structure markings, such as possible change of character, possible high, or possible higher high. The purpose is to make the structure easier to read visually, especially for beginner traders learning market structure in real time. These markings help identify where a potential change of character or break of structure may happen before confirmation. This is especially important during live trading because price is constantly developing. A possible high or possible higher high is not fully confirmed yet because price may continue moving higher before a retracement forms. That is why we continuously track the structure and update where the current possible high is forming until the retracement confirms the move. And that single word, possible, is your first defense against the trap. Acting early is exactly what an inducement zone is built to reward. And with that understanding in place, we can now begin analyzing the chart step by step and follow how the market structure develops in real time. In this example, we will be using the Euro-USD pair in the forex market, analyzing both the 4-hour and 1-hour time frames throughout the entire setup. Let's begin by opening the 4-hour chart to identify the key zones and understand the broader market context. In this case, we have marked two important order blocks, one demand zone order block and one supply zone order block. Since price is currently trading inside the 4-hour demand zone, the next step is to move down to the 1-hour chart and look for a possible structural shift that could provide a high probability trading opportunity. On the 1-hour chart, we begin marking the key areas and identifying important points such as the lower high, the lower low, the possible break of structure, the potential bullish reversal, and the buy side and sell side liquidity zones. The main objective here is to determine whether the market is starting to shift direction inside the higher time frame demand zone, which could provide a strong and valid trading setup. As price continues developing on the 1-hour chart, we begin to see early signs of reversal. The market closes near the lower high and surpasses it with a wick, creating a possible bullish structural shift. However, this transition in market structure is not fully confirmed yet. Confirmation will only happen later, with another wick above the lower high or with a candle close above that level. At this point, we can also begin marking the fair value gaps forming on the chart, since these areas may later become important execution zones if the structural reversal is fully confirmed. On the following candle, price once again creates a wick above the lower high, confirming the bullish transition in structure. With the reversal now confirmed, we can begin marking the new low and identifying the possible high forming on the chart. Now that the structure is confirmed, we can map the Fibonacci retracement and identify where the premium and discount zones begin to form. As we can see, the fair value gap is positioned around the premium zone, which will become our primary execution area for this strategy. In a strong, impulsive move, price often never retraces into discount at all, and waiting for a cheaper entry usually means not taking the trade. So we accept a higher price in exchange for a higher probability of being filled, and the risk model is what pays for that decision. And here the first reading appears. A fair value gap exists because one side overwhelmed the other and left an inefficiency behind. Most traders chase that empty space, entering wherever price happens to be. Waiting for price to come back into the gap is the opposite behavior, even when the gap sits in premium. Before opening any position, the most important thing is to fully understand the logic behind the setup, the execution area, and the risk management model that will be used throughout the trade. For this fair value gap setup, the stop loss will be based on the size of the fair value gap itself. The entry will be positioned around the 0.382 Fibonacci retracement level, and the trade will be managed using two separate targets. The first objective will be placed at a 1-to-2 risk-to-reward ratio, where 50% of the position will be closed. The final target will be placed at a 1-to-3 risk-to-reward ratio, where the remaining 50% of the position will be closed. Once the stop loss and both targets are positioned, we can see price retracing directly into the setup and beginning to move toward the first objective at 1-to-2. As soon as that level is reached, 50% of the position is closed and the stop loss is immediately moved to the entry point. This is one of the most important parts of the strategy, because once half of the position is closed at the first objective, the trade has already secured profit. Since only 50% of the position remains open and the stop loss has been moved, there is no longer any possibility of turning the overall setup into a losing trade. Even if price reverses after this point, the profit already secured from the first partial close guarantees a positive outcome on the overall position. Notice what that does to the trader, not only to the account. Loss aversion is strongest while there is still something to lose, and removing that risk ends the negotiation. After securing the partial profit, price continues moving higher and eventually reaches the final target at 1-to-3, closing the remaining 50% of the position. One very important and interesting point regarding this strategy is that price is still trading within a bullish trend and has not yet reached the 4-hour supply zone. Because of that, the market still has room to continue developing to the upside. As the next candles begin to form, we can see price retracing back into the demand area before creating another bullish movement higher and breaking structure once again. During this new impulsive move, price forms two fair value gaps, giving us a completely new structure to analyze. At this point, we begin marking the new trading range by identifying the low and the possible high, while also marking the key areas where a potential break of structure or a possible bearish reversal may occur later in the development. From there, we execute the strategy once again, following the exact same process and risk management model used previously. In this specific case, since two fair value gaps were formed during the bullish movement, we will position the order at the beginning of the second fair value gap, which is located closer to the 0.382 Fibonacci retracement zone. Because of that positioning, the first fair value gap, the one located higher on the chart, may potentially act as an inducement zone before price moves deeper into the second fair value gap and fills the intended entry. This is the trap the entire video is built around. Two gaps appear inside the same impulse, and they are not equivalent. The higher one is closer, it is reached first, and it rewards the trader who cannot wait. The market needs orders resting above before it can reach the ones below. The trader who fills the first gap is not wrong about the concept. He is early, and early is expensive. Same idea, worse price, wider stop. That is the difference between being the liquidity and using it. Once the strategy and orders are positioned, we can observe the next price movements developing on the chart. The following bearish candle retraces into the beginning of the second fair value gap, reaches our planned execution zone, and then quickly reacts to the upside. From that point, price moves directly toward the first objective at a 1-to-2 risk-to-reward ratio. As soon as that level is reached, 50% of the position is closed and the stop loss is moved to the entry point, securing partial profit and protecting the overall trade. After the first target is completed, we continue monitoring the next price movements, while allowing the remaining portion of the trade to develop naturally. As bullish momentum continues, price eventually reaches the final objective at a 1-to-3 risk-to-reward ratio, where the remaining 50% of the position is closed, fully completing the setup with another successful trade. One important point to understand at this stage is that price has now reached the 4-hour supply zone. From this moment forward, it is no longer ideal to continue looking for long positions, because the market is now trading inside a higher time frame area, where selling pressure carries significantly more weight. When price reaches a major supply zone on the 4-hour chart, the overall upside potential becomes much more limited, and the risk to reward for additional buy positions starts to decrease substantially. This happens because the sellers operating on the higher time frame have far greater influence over price movement than the buyers operating only on the 1-hour chart. In other words, even if the 1-hour structure still appears bullish for a short period of time, the market is now approaching a region where higher time frame participants may begin defending positions and pushing price lower. And here, the trap changes shape. It is no longer a gap below your entry. It is a setup that still looks valid after the reason to take it expired. 2 winners make the third feel obvious, and that is the one to leave alone. And this is where the market dynamic begins to change completely. In the following candles, buyers gradually lose control, while higher time frame sellers begin stepping into the market aggressively. As we can see, price starts dropping sharply from the supply zone, creating a clear bearish structural shift and confirming that momentum is now transitioning to the downside. That is the thread running through everything you have just seen. The higher time frame told you where to look. The Fibonacci told you whether price was expensive or cheap, and the second gap told you where the real orders were resting. Each moment offered 2 readings, and only one belonged to you. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.